Initial observations of the long-term situation. A sustained downtrend that has flattened. Some gap downs provide excellent reference for resistance, mainly from open and close prices from candles just before and after the gaps formed. The prospects for a long-term recovery are halted around 2980, which is near the opening price of the last major gap down. The opening price of a gap, whether it be a gap up or a gap down, is usually more important because the concentration of orders built up since the last trading session start to be executed right at the open of the trading session when the gap appears. There was normal to weak bullish volume during a brief pause around 28, the site of the only upswing in 2004 so far. Support was eventually overcome with a clear bearish acceleration, showing stronger closes lower and increased red volume. This was indeed a double top that extended the already prolonged trading in the mid to lower 20s. More progress a few years later in moving higher in the gap down zone, though the results are similar. Strong resistance remains and there is another double top. That is part of an even larger head and shoulders reversal. It is also interesting to see the shoulder level focus around the still influential 2980 level. Major long-term resistance can eventually dissipate, especially in a case like this, where an equally long-term horizontal range is maintained to avoid further drops after major bearish reversals. It also helps a strong uptrend began into the 2010s, along with a broader stock market recovery around the same time period. 3215 is still used because the more recent gap up almost opens at this exact same price level. Since the gap fill, the overall recovery continues, with supporting upswings gradually higher above 3215. Despite strong bullish spikes, the medium-term picture is largely neutral as a horizontal range takes hold. Short-term developments go neutral to bearish, with continued resistance in the mid to upper 30s. A major bearish surge is even more severe due to the gap down, in combination with the completion of a triple top. That is in part why the gap down zone and the old 3215 level are easily breached with strong sustained selling. From these factors, it is clearly not an ordinary gap down. The more recent gap down levels are taken directly from the large gap down candle's real body. Nothing lasts forever, and that is true for the bearish move. That does begin to get exhausted as there is almost no selling pressure. A double bottom is emerging, but it will face immediate opposition from the past gap down zone. Incidentally, the 3215 level is quite helpful. It is near the approximate minor downswing in mid-August to conveniently define the upper boundary of the proposed temporary double bottom range. A picture-perfect start to a normal stable uptrend from the double bottom. The return of bearish sentiment can mainly be traced back to the single spike in early October. That just barely filled in the gap down by contacting 3560. Even without the broader context, it was an obvious short-term bullish overextension. Bearish sentiment persists, but similar to before, it begins to dissipate over time. Currently, it is quite clear the triple top gap fill zone is experiencing heavy bullish pressure. Some normal consolidation, but the mid-30s range reverses roles to offer such strong support. There is a clear incline prior to another steep climb. Finally, the 41 range is recontacted to revisit the now very old gap down. Incredibly, but not out of the ordinary, this does offer some resistance to the strong uptrend. Later, the upper 40s range of the first gap fill zone is reached, and produces a perfect retracement by dropping down and bouncing off the 41 range to continue climbing. The upper 40s then reversed roles to support multiple drops to show it still had great influence in the long term. Clear swing points, large candles, and a recent gap up are features that often had high volume in the mid-60s. Now it will be crucial to see how well the gap fill support holds, especially after such a swift bearish reversal from the thicker gravestone doji in the past week. The gap is filled and the range provides immediate support to several minor downswings that continue to develop a downtrend from the initial peak. This does point to a possible descending triangle in development, though it can be difficult to analyze in cases like this where the swing points are in such a small range. It can be helpful to have several trend line variations. Sometimes the actual pattern might have a trend line that has a candle pierce it temporarily even without exceedingly high volume. Trend lines for chart patterns are sometimes drawn with compromises between candle price action and volume. It is indeed a descending triangle that has completed with the characteristic break of increased volume and stronger lower closes. The early downtrend is very likely to continue. There was a delay to the drop due to the mid-60s range being both a gap up fill and descending triangle support zone. Also, volume was generally normal to low before the bearish spike in the last 2 days. This bullish reversal can be defined as a double or triple bottom, depending on whether you just count closing prices or include wicks, such as the large wick of the bull hammer in early June. In any case, a defined horizontal range has been crossed with high volume, and the descending trend lines now provide useful guides about the progress of the developing uptrend. It is a strong uptrend, and every time the descending trend lines are passed, the climb continues. Eventually, longer-term bearish sentiment prevails, and the upper 40s range manages to slow down the next sharp drop. As usual, a major resistance range from a bearish pattern retains influence even years later. It is a likely completion to a double top that shows a slight incline with the 2 downswings. Interesting to note, the reversals off 6330 form a mini double bottom within this temporary range. Such price action can add to more strongly identifying a reversal range, whether it be double or triple tops and bottoms. A classic strict double top ends with strong support from the upper 40s range that remains a useful landmark, even almost 20 years after the gap down seen at the beginning of this case study. Later, the double top range provides clear resistance as would be expected. Price levels, ranges, and even trend lines from major chart patterns could be adjusted to conform to more recent price action. However, in most examples, such as this one, the old unchanged chart pattern landmarks are more than adequate, especially when looking at them in the short to medium term with current candle price action.